Okay, today we are going to compute the value at risk. What is basically value at risk? Value at risk is the maximum loss an organization, an investor, an investment will occur at a specific time and at a specific date. So value at risk in simple word हम कहते हैं कि ये हमारे पास maximum loss है जो कि हमें बेयर करना पड़ता है एक इन्वेस्टमेंट के ऊपर. यूजुअली हम वैल्यू एट रिस्क को थ्री डिफरेंट मेथड से we solve the value at risk by using the three different method, starting from the historical simulation approach, using the historical values of assets A, B, and C, whatever the clause is, and then we use the variance covariance method to compute the value at risk, and another one is the Monte Carlo simulation approach. So today's lecture we're going to compute the value at risk using the historical simulation approach and also using the Monte Carlo simulation approach. For the historical simulation approach, you need some historical data of any of asset, any of security. Like in today class, we are going to measure the value at risk for a portfolio. So we are using two different securities from Pakistan stock market. One is HBL Habib Bank Limited. The other one is Allied Bank ABL Limited. And the historical values on the share prices for these two securities for the given time period. So first step is just to record the returns of that that stock, how much you return you get on a specific date. So for that, we first of all we calculate the returns. For returns, we use the Excel function ln, which is natural log, and divided by the beginning divided by the ending value. So here is the return for HBL on the day 3/9/2018. Then simply we drag that, and similarly we compute the returns for ABL. Again, ln natural log beginning divided by the ending value, and that's okay. So here what we got the return in term of percentage, like on 9th of March 2018, the investment on the HBL suffer like 1.4% of the losses, whereas the ABL suffers from the 0.08% of the loss. So let's assume you have a portfolio and you have invested around 10,000. Let's assume we say the 10,000 rupee in investment in HBL and 10,000 in ABL. So to return in dollar term, in rupee term, we simply multiply the amount you have invested in HBL multiply by the return you get on the specific date. So here is the return, like in negative return, you have made minus 146 rupee loss on HBL on 3/9/2018. Simply drag that value. Let me check where's the issue. Like, okay, we have to put a dollar sign over here. So take this value as a constant. Oh, sorry, not the dollar sign here, but here. We constant the value of 1,000 and then simply multiply, and you can see on the 12th of March 2018 we get the 95 rupee of profit on the 10,000 investment. So similarly we do the same exercise with ABL, just multiply with the total investment and the invest, and we got the return on that. Okay, for the portfolio return, we study the portfolio. Portfolio is the combination of two or more securities. So let's assume we have the total portfolio of 20,000, like 10,000 HBL and 10,000 in Allied Bank. So our total portfolio is 20,000. So how to combine the return? Simply, we will sum up these two returns of dollar terms. Then we got the total return on the portfolio, like minus 234 rupee loss. We have recorded the loss of 233 rupee on the 9th of March 2018. Similarly, we got the profit of 201 on the date 12th of March 2018. The next step is the computation of value at risk on that investment using the historical simulation approach. The how much on the given on that given level of, like, we have the data for 3 or 4 years or 5 years. On these 5 years, how much the maximum loss will have occurred. So we use the percentile function. Using the percentile function, now you have to select array. We have the portfolio return, so we select the array till loss date. Then it says that select the k. K is the percentage, is the confidence interval you want to compute. Like, we usually compute the value at risk at 99% and 95% confidence interval. So let's assume we are going to compute our value at risk at 99% confidence interval. For 99% confidence interval, I will use 1 as a percentage which is left over, and then hit okay. So we have noticed that we suffered a loss of 854 rupee on 20,000 of investment for the given time period. So yes, that is the historical simulation approach. For there is an updated method for historical simulation as well, which is known as filtered historical simulation approach. In that, we use the volatility as a base for computation of the value at risk. Another method is now the next method is simulation, Monte Carlo simulation approach, in which we generate a series of the series a series of array using a random number like seed values. That seed values represent the random model, and the number of iteration which show the process, how many times we will generate these values. Like in this example, we are using like 1,000 iterations for this purpose. Okay, and the next step is how to generate. The question is how you gonna generate these random numbers. We will these values, like in previous example we mentioned that the portfolio value, we have the portfolio of our 20,000. The weights for the portfolio, HBL 50,000, weight for ABL is 50,000, risk-free rate. For in this case, we are assuming that the risk-free rate is 0%. Expected volatility, the volatility in the market, we have computed using the volatility modeling, autoregressive conditional heterostochasticity, is 0.26 or 26.51%. And the times days, the number of trading days in a month, like we are assuming that there are 22 days in a trading month. So we using this basic information, we are going to compute our we are going to use the Monte Carlo simulation approach to generate some random number, random iterations, and then using that random array to compute the basic value at risk. For that purpose, we are going to use the expression from and a formula from starting from is equals to exponential, using the exponential number. Then we use the risk free rate minus zero point 0.5, and then we will multiply with the volatility, sorry, the variance, sorry, then multiply with the variance. For the variance, I have the volatility sigma. So for the variance, we will take the square of that value, then bracket close again, multiply with the number of days, trading days divided by the total number of trading days in a year. Let's assume we have 252. Almost on a year basis, we have around 252, 250, from 250 to 260 trading days in a year. Then we will add the volatility, the sigma back. Then we will take the square root of the difference of what? The number of days traded divided by total number of trading days in a year. Then we will multiply by we generate the normal inverse relation, return of inverse. Then we took the random values. We use the rand function for the probability, then enter and enter. Simply, we will hit enter button on this. Sorry, we get an additional over there. Okay. The next thing is we use to compute, iterate our model for 1000 time. For that purpose, we go to the data. Okay, in data we go to the what if analysis, then the data table, and before that I will select, wait a minute, sorry, I will select the whole time period. You can use that 1000, 5000 iteration. It's up to you. 5000 iteration, you want 5000 iteration, 10,000 time. Usually, for better performance, the number of iteration you will increase, the more accuracy will increase. Okay, again, we will go for the what if analysis, then data table in column input cell. From input column we will add each, and okay, you have seen the iteration. It generated the random number using the background information of this available information. Then for the value at risk computation, again, we have the confidence interval of 99% and 95%. For the 95% confidence interval, we will use the function 1 minus, again, percentile, using the percentile feature. Then we will select the array. So we're gonna select this array, then comma, and the next step, going to choose the confidence interval. So we are calculating at 99%, so I'm using 1% and bracket close. Okay, for 99% of confidence interval, again 1 minus percentile, and then choose the array. And for the k, we will use the 5%, 5%, and hit enter. Every time when you hit an enter button, you will notice that the random numbers will be generated over there. So for the absolute loss, you have to convert this loss into a number, like how much amount you're gonna suffer from a loss. So we have 20,000 of total portfolio amount, multiplied by this loss. So on this investment, we have suffered from a loss of 3,424.501 rupee of loss. So that is the Monte Carlo simulation approach to compute the value at risk. In that Monte Carlo simulation, use the random seeds, random values, and based on that, not the random values, basically it used your financial information, the required information, and based on that information it computed a random number, a random seed, and using that random seeds we have computed a value at risk on our given investment.